Welcome to your Innovation Coffee Break. I'm Vijay Rajendran, Head of Corporate Innovation and Partnerships at 500 Startups Ecosystems Group. We join leaders with unique perspectives in these conversations that are in the world of innovation and startups and venture capital, in the time you need to sip a cup of coffee. And we'll have some unique conversations. We're going to have one such very unique conversation today. I'm excited to be joined today by Jim Adler of Toyota AI Ventures. Jim, welcome.
Vijay, thanks for having me.
It's a pleasure. Jim, to begin with, I'd love to dive into your background, in particular, your really interesting journey from founder to VC today.
Yeah, well, it hasn't been linear, Vijay. It started as a rocket engineer working for what's now Lockheed Martin, working on avionics systems for Atlas Center and Titan Center and Space Station Freedom projects, and loved it, loved the work right out of school, working 18 hours a day in labs and at launch installations, and it was fantastic. But I had this real sort of entrepreneurial itch that I wanted to scratch, and I spent probably the next 20 years scratching that itch in many startups, from everything from online voting to data broker, to scale out data analytics, enterprise software companies, and tended to do like a startup, and then I would rest, and then I'd do a startup, and then I would rest, usually in an acquisition, because startups are just emotionally so draining. And the last company was a scale-out data analytics company called Metanautics that was backed by Sequoia Capital and Workday, and I ran products and marketing there, and we ran it for about 3 years. Microsoft came calling, we sold it to Microsoft, and I was going to rest at Toyota, and because Toyota Research Institute was just getting started, and their cloud and data team was getting set up, and I had done that a couple times before, so it was something that was relatively well-traveled ground in my career. And then I was sort of getting the itch to do something new, and Toyota Research had a bucket of capital they were going to invest, but there was really no structure around it. And so I had some very hard opinions on especially corporate venture capital, because I had raised a bunch of money in my career from institutional VCs, but also corporates like HP and Cisco and others. And I had experienced really great corporate venture capitalists and really poor corporate venture capitalists. And I wanted Toyota to be a great corporate VC. And so I had sort of a manifesto of principles that I thought were really important. And we structured a program, sold it, up the chain, started small with a $100 million fund in July 2017, and then a second fund in the spring of 2019, so 200 million under management, and it's been a really interesting ride. My advice to younger folks charting their career is, don't over design it. Right, there's a stint in my career when I was a chief privacy officer, right? And I never anticipated that. I had a whole set of blog posts around my accidental chief privacy officer stints, and now I'm the accidental venture capitalist. So you really can't chart these things. You have to sort of let them be organic.
Yeah, I think a rich life and an innovative one is full of these like happy accidents and like some of these non-linear experiences. It's only when we try and recite it chronologically, it sounds vaguely linear, but the world really is.
It sounds well designed in hindsight. In foresight, it's not completely, but largely random and serendipitous and opportunistic. And I think that's what you want in your career. You want to prepare well, and then listen intently.
For sure. Speaking of intention, you were very intentional about the thesis for Toyota AI Ventures, and it's super interesting. Can you tell us about it and share with our audience what stage and verticals are interesting to you? Because I'm sure there are some founders who are curious about what you're excited about.
Sure, absolutely. So, we start with a mission, right? Why are we doing this? Well, our mission is that we are explorers for Toyota to discover what might be next. And so once you think about that mission, you say, okay, if you're going to explore, you need to then be early stage, because that's where a lot of the exploration happens. And so we are early stage investors, typically seed and A, in areas that we think could become interesting businesses down the line for Toyota. And I always believed that startups are experiments in the marketplace. And so we want to understand we want to have a front row seat to the best experimenters, the best startup teams. And so our thesis really is strategic, right? The thesis is early stage in artificial intelligence, autonomy, mobility, robotics, data and cloud technologies. So it's very much around where big tech is and going, because fundamentally, as Mark Andreessen famously said, right, in that 2011 Wall Street Journal op-ed, is that software is eating the world, and the automotive industry is now on the menu, and we need to understand that, and the insurgents into this industry are largely going to be big tech. And so the software, data, artificial intelligence technologies, and more importantly, disruptive business models are going to be where the winners and losers are going to be found. And so that informs our thesis.
So, what a lot of people spend their time doing is trying to get to a theory of what is happening and a perspective on the future. Did you ever have any particular tools or processes you use to get to these like areas of focus? Was it based on some scenario that you imagined in a future state, with particularly software approaching transportation and automotive?
Yeah, well, I mean, I think, yeah, absolutely. With respect to, we knew and know the industry is being disrupted. Akio Toyoda, our president, said a few years ago that Toyota is now a mobility company, not just an automotive company. And so that was I think a great visionary statement toward the future, that it isn't just about cars, it's about how we move. And if you think about how we move, that's a pretty broad statement. And we see new technologies, new mobility modes coming in to our industry, but generally just helping people move, and getting more efficient as these technologies move into our space. So whether it's as a service business models for either software or robotics or other hardware as a service models, subscription models, personally operated vehicles as opposed to personally owned vehicles, ride sharing. These models are going to sit on top of a set of technologies that we believe are at the point of maturity where they can actually be leveraged by innovative business models. So one of my theories is that, and not just mine, but that technologies will mature to a point that they become useful. They pass a tipping point of being useful. And then the business models come in to bring those technologies to the markets. And so a great example is music technology, where for 60 years before the MP3 player, music was digitized, and that theory was laid down. And by the time we got to the late 90s, you then saw MP3 players and then iTunes, and then buy by the song, and then a bunch of bit around subscription, and then bundling, and all these things came around buying music, buy the song, buy the drink, or then buy the subscription. And that was enabled by these technologies. And we think the same thing's happening in mobility, where software, artificial intelligence, data cloud, robotic technologies are now reaching this tipping point, and they're becoming incredibly useful. And now the question is, what do you do with them? And that opens a whole era of possibilities.
So, I think you hit on something really important, is like the technologies are there, and then there's just like a moment where you get to really use it. And in some respects, those moments are arriving faster, and in other respects, they're kind of paused based on COVID-19. Mm-hmm. So I'm curious what particular headwinds and tailwinds, as I've heard you describe before, are observable here in the market.
Yeah, it's something that we think about a lot. I think we thought about, of course, before COVID. Every venture capitalist knows that being too early is being very wrong. So, you want, timing is everything. But you can't centrally plan success. You have to get in the game, you have to play the game, and you have to readjust as the game develops. And so COVID was and is looking to be a tectonic shift in many ways. And in some ways, markets are now paused or significantly set back. Other markets are accelerated and set forward. And so if you look at certainly travel and hospitality and certain mobility modes, those are set back or paused. And others, like the one I like the best, that I think puts a really fine point on it, is manufacturing supply chains. I'm a big Nassim Taleb fan, and if you look at our supply chains now, they are incredibly fragile, but incredibly efficient. Okay, so we've wrung all the cost out of them in exchange for fragility. So as Warren Buffett said, right, the tide is going out, and we're finding out who is swimming naked. And so these supply chains that were not resilient to these disruptions like COVID, but it doesn't have to be a biological, medical disruption. It could have been a political disruption. We're not diversified enough. Yeah. And so we think manufacturing supply chains really going to be diversified. Costs are going to go up, but resiliency is going to go up too.
Yeah, I think that's true. People forget we were facing a number of things, trade wars, other dynamics, which could have put us in a similar situation. And it seems like redundancy, which until now was considered waste, or diversification, can be a source of strength.
Yeah, the wisdom of the spare tire, is true in supply chains as it is in your Lexus. So I think that's important, right?
Yeah, for sure. That's super important. And I'm curious, do you see founders that you're talking to thinking about how to make their business models a little more anti-fragile?
I do. I think startups are actually built for anti-fragility. They are small, they take in information voraciously, and they pivot, right? And in fact, startups talk about the pivot because it's such a baked-in anti-fragile tool, right? They take in information, they change. They take in information, they change. In fact, Toyota pivoted in many respects from industrial textiles in the 1930s to cars, right? And that there's, as big as Toyota is, there's this entrepreneurial vein within the company, which I certainly resonate with, and it's so exciting to be part of. But startups have that too, and really it's their only superpower, really. Speed and their ability to change quickly. And so you see, like across our portfolio, taking this new information, having the humility to chuck away previously adopted principles around their business model and go to market and even product in exchange for an opportunity they see. And I think the companies that can't make those pivots are having a much harder time. And that's why early stage investing is all about team, humility and confidence, right? That delicate balance.
That's super important. Taking that, innovator's dilemma problem inside a big company and then asking deliberately, how can we break ourselves? And if there are teams with that humility and ability to question themselves in a smart way, that's a super helpful trait in a lot of the companies that we've seen grow from like the seed stage when they get to know us at 500 startups to one or two pivots later when they figure out what they really are when they grow up.
That's right. Yeah. And you bring those with you, and you see the ones that fall away are either not humble enough to listen to the market, or they're so confident, almost arrogant, that they just overbelieve what they have previously believed, and they might be afraid to admit they made a mistake. But as I always believe, that the universe, when the universe wants to teach you a lesson, it will tap you on the shoulder, then slap you in the face, then hit you in the head with a 2x4 until you get the message. And sometimes that hit in the head with a 2x4 can put a startup out of business. And so you want this sensitivity to the information coming in. I think that's the anti-fragility that Taleb has talked about.
Are partnerships with startups also something that you've pursued or looked at in addition to investing for Third AI Ventures?
Yeah, I think it's a very important structural construct. I think corporate venture capital traditionally has looked, in my opinion, too inward toward the corporation and not outward toward the startup. And so corporate venture capital is very much a semi-permeable membrane between the corporation and the outside world. And if you are not permeable enough, you tend to be too focused internally and not focused enough externally. So when we structured ourselves, I really wanted to make sure that we had the right balance. And so we have a deals team that is focused very much outward, deal flow, doing clean deals, getting the best startups and teams for our investment opportunities. But after the close, we have a platform support team that is fundamentally all about helping them grow in the traditional ways of recruiting and helping them with product market fit and evaluation, but also connecting them to Toyota. I mean, Toyota has 370,000 employees around the world, around manufacturing, design, distribution, all kinds of businesses that I learn about every day, that Toyota is in a different business I had no idea in different parts of the world. And doing the impedance matching between the startup's maturity and the business unit's receptivity to that maturity. Like some groups within Toyota, they don't want to talk to a snot-nosed startup, right? Initially, right? But other groups are very much open to it. They're all about, they feel the pressure in their part of the business and they want to see all the innovation they can. Others want to wait and see and let the startup get more mature before they engage. And I think if corporate venture capitalists can respect the difference between those two. I mean, I come from a long line my father and grandfather were both doctors, right? I broke their heart and didn't become a doctor. I became an engineer. But
I did something similar to my father.
Yeah. You see, sons always break their father's heart in some way, shape, or form. But the Hippocratic oath of do no harm, which is true with any system, whether it's medical, engineering, business system, do no harm. And if corporates can do no harm to these really anti-fragile, but yet still delicate startups and respect that, let them grow, and then connect them to the right opportunities within their corporation, that's a huge win for these companies. And I think corporates don't always get that trade-off correct. They're either too concerned with their own internal politics, and then they're insensitive to how delicate these startups are, and they either bear hug them out of existence or they ignore them. And if you can not fall for those traps, a corporate VC could really help these startups and actually accelerate their business, which is good for everybody.
Yeah, that's right. There can be a lot for both sides to gain under that approach. It sounds though like there's a lot of interest from top management, and then they believe there's something that's going to be important for them to learn from these experiments, from disruptive technologies, and that means something to them.
Absolutely, and you see that even publicly. There's been two big follow-on investments by Toyota in a couple of our portfolio companies. One is Joby Aviation, where Toyota Motor Corp led their, I think came in at about $600 million latest round. May Mobility's $50 million round, TMC led. So I think they're seeing that there is some value to startups and helping Toyota to figure out where the world is going and what capabilities might be important to win business in this new world. And that's what startups are really good at. Big corporations are not really good at taking risk. Startups are built for risk. And if you could leverage this in a win-win, that it could be, I think it is really powerful.
Yeah. We did a survey of over 100 CVCs. We found that a slight majority of them are investing off of the balance sheet, which is kind of a strange behavior if we recognize that most companies and the balance sheet itself is not really built for that kind of risk and illiquidity and a bunch of things like that. Do you think more CVCs should seek independence?
Absolutely. I mean, this is something where we're all in on being independent. We're a separate company. We're structured like a institutional venture capital fund. We are a GPLP structure with a clear capital call process, incentives like a VC fund. And I think when we structured it this way, we knew that there would be a business cycle, there would be a downturn. We didn't know it would be a global pandemic, but we knew there would be a downturn. And we felt that in order to attract the best startups, there's two things that you need. You need alignment on interest and you need alignment on commitment. And interest means we all want the same thing. And everyone around the table, everyone loves the mission a startup is on, but the financial return is really important to the other venture capital investors as well as the startup team. And so we prioritize our financial return over our strategic return. Our thesis is strategically informed, as we discussed, but in any individual deal, we want to make money, the startup wants to make money, the co-investors want to make money. That's principle one. Principle two is alignment on commitment. We want to be here through good times and bad, just like your other investors. And so the separate structure where we don't invest off the balance sheet, but we have our own decision process and a dedicated fund means that we will be there when the startup needs us. And we deal with the timing dynamics of our fund, not our corporate parent, just like all the other investors do. So it means that when a startup takes our money, they can ask the same questions. How much dry powder do you have? What's your follow-on allocation? When do you tend to do follow-ons? What criteria do you use? All the diligence questions any startup would ask, they can ask of us, just like they ask of any other VC. And then they get a sense of, okay, these folks are committed to my company. And I can feel comfortable they're going to be there when we need them, because as you know, nothing goes straight up. And I think those two principles are very important, and that has to be reflected in the way you're structured. And when you're off the balance sheet, investing off the balance sheet, you can't really represent that as well. In some cases, it's very difficult to represent that and follow through on it to your startup investments.
Yeah, coming back to the downturn that you alluded to, are you seeing innovation slow down? Are you seeing also the pace of investing like change? A lot of VCs are saying they are open for business, but it's hard to to move at the same pace that perhaps they were prior to both the downturn and, of course, the pandemic.
Yeah, I think there's a couple things going on. One is the general economic slowdown is going to depress activity and therefore prices, and maybe 20 to 30%. And I think there was a National Venture Capital Association article post that I participated in. I had a quote in there that said that a lot of CVCs are still operating. They're still active, but there's been a little softening, okay, and which is not unexpected in this environment. So I think that is, with any business cycle, you're going to have a little softening. We've been pretty active during this period because we like the lower prices, and we think innovation is continuing. But the other principle or other phenomenon that's happening is the world is moving toward a new normal. And I don't necessarily think that we're just going to get back to the old normal. I think there is going to be a new normal that's sort of setting in. We talked a little about diversified supply chains, more robotics coming into certain sectors, personally operated mobility, the general unbundling of mobility, I think, is a phenomenon that's not going away. So investors need to understand those two phenomenon and how to leverage that. But I don't see any slowdown in innovation. Precisely your question. I mean, people are still creative. I almost think when challenged, there's going to be more innovation, because people are going to say, wow, all the rules, everyone has upended the table, or the pandemic has upended the table, and now there's a lot of opportunity. And that's exciting for startup entrepreneurs.
Yeah, for sure. Yeah, and the necessity breeds invention. It also breeds creativity, and we should see that. Yeah.
Yeah. No one's comfortable, and if you're not comfortable,
that's right.
you're going to be creative. Yeah.
Yeah. As someone who has built a career in a past life, in Seattle, for example, and is now based in Silicon Valley, what do you think about the future of SF and Silicon Valley as as obviously a tech and startup hub, and what does the future take shape to look like?
Yeah, a really good question. I think that the momentum and the hub of Silicon Valley is not going away, but I think the spokes are going to get stronger and thicker. And whether that's down to LA or up to Seattle or east, and down from Boston and New York, and up from Dallas, and so I think that the good thing about the remote work that many of us are experiencing is, I think these spokes and the opportunities that these thickening spokes bring is getting accelerated. And so a lot of VCs used to have this rule, like, I don't do a deal unless I meet the founder face to face. Well, that's not tenable now. So we've done a couple deals now where I've never met the founder face to face. We've done a lot of this, a lot of Zoom, a lot of video, but not a lot of no face to face. So that is a huge opportunity for entrepreneurs all over the country, because I think the talent is relatively equally distributed. The capital isn't. So do these spokes create channels of capital across the country? And we can actually now leverage that talent, which means more opportunity, more productivity, less pressure on prices in these startups. And I think it's a win-win-win as we go through this. And we're looking we have a couple investments up in Canada and the Midwest, and we are looking elsewhere too, because we think Silicon Valley doesn't have a monopoly on talent. Might have a bit of a monopoly on capital, but not on talent and not on work ethic. That is relatively evenly distributed. So our job is to inspire entrepreneurs around the country and around the world to engage and trust their gut and find their muse and solve tough problems. And we want to be on the journey with them.
That's super exciting. And, you know, we went through a similar experience this year, taking our flagship Silicon Valley Accelerator, making it global and virtual and available everywhere. Before it was available to anyone who is the energy and drive to come join us, of course. But now, I think Silicon Valley is a state of mind. It's a community that's not so geographically focused, and it's exciting to see how you're investing, more and more in different places around North America and the world. So thank you for that. I think we are out of time, amazingly, it just flew by. So we're gonna have to leave it there. But Jim, thank you so much for joining us today. And this was such an engaging conversation, and really value and the thoughtfulness and, forward-leaning, approach you're taking to venture and innovation and what you're bringing to this community. So thanks so much.
Thanks, Vijay. This has been a lot of fun. Thanks for inviting me. It's great. Thanks.
My pleasure.